Hi, I'm Whitney Espick, the CEO of the MIT Alumni Association, and I hope you enjoy this digital production created for alumni and friends like you.
Good afternoon, everyone. Welcome to the Faculty Forum Online, a program of the MIT Alumni Association, sponsored in part by MIT Professional Education. I am your moderator for today, Lorry Spitzer. I am a member of the Office of General Counsel at MIT. Our guest today is Bob Pozen, a senior lecturer at MIT Sloan School of Management and a senior fellow at the Brookings Institution. We asked Bob to chat with alumni today about the new tax bill and its implications on those alumni who own or lead a business. As a reminder, we welcome your questions during this chat. For MIT alumni joining us via Zoom, please use the Q&A feature found at the bottom of your screen. For all others listening in on YouTube, you may add your questions to the comments field. We will pause halfway through the program for questions, and will also leave time at the end for additional questions. And now a few words about Bob Pozen. In 2012, Bob won acclaim for a popular book showing professionals how to get more done at work, entitled Extreme Productivity: Boost Your Results, Reduce Your Hours. During his distinguished career, Bob has been active in business, government, and academia. Prior to joining MFS Investment Management, he was vice chairman of Fidelity Investments and president of Fidelity Management and Research Company. In late 2001 and 2002, Bob served on President Bush's commission to strengthen Social Security, where he developed a progressive plan to make the system solvent. In 2003, Bob served as Secretary of Economic Affairs for Massachusetts Governor Mitt Romney. In 2007, he served as chairman of the SEC's Committee to Improve Financial Reporting. Bob frequently writes articles for the Financial Times, the New York Times, the Wall Street Journal, and the Harvard Business Review. He has published a book on the 2008 financial crisis entitled Too Big to Save? How to Fix the U.S. Financial System, and a guide for investors entitled The Fund Industry: How Your Money is Managed. Bob Pozen, welcome. I'll turn the floor over to you.
Thank you very much, Lorry. Appreciate it. And welcome to everybody here. So we're going to try to cover a very broad area, the new Tax Act. And we're going to start by looking at an overview of the big changes for the corporate side and the partnership side. Then Lorry will ask a few questions at that point, and then we'll go on to look at a more detailed analysis of the international provisions and some of the individual provisions, and we'll take questions again. So we'll have two Q&A chances. If you don't get in on the first one, you can send your questions on the second one. So, okay, I'm about to change this. This is not moving forward. The slide.
This one?
Yeah.
Delightful. Crap.
We're having a little technology issue here. Can someone else move the slide forward? New
Stop sharing for a moment.
okay.
Not new share. The red one.
Excuse me?
Yeah.
This one?
Yeah.
Okay, Lorry, so should we try again, share screen? This?
Yes.
Okay.
Click yours. Share. And go to this.
Yeah. Okay, now we got to the right place. Okay, so the big news here is that the federal corporate rate dropped from 35 to 21%. Probably more relevant to a lot of companies is that there's a combined federal and state rate of 26, and that the AMT was eliminated means that the effective rate for most companies is going to be 17, 18% for those with mainly domestic business, and as we'll see, much lower for companies with international business. This puts the U.S. at 21 to 26%, a little lower than the GDP weighted average of 28%, which includes countries like France and Japan, which are a little higher. But the unweighted average of industrial countries is about 24%. And so we're very much in that range. Big question that's going to be debated is what happens with these new after-tax profits. There is no limitation that says that this money has to go to dividends, or that it can't go to dividends, or that it can't go to share buybacks. There is an incentive in the Act for immediate expensing of U.S. investments in new plant and equipment. So hopefully that will encourage people to put more money in new plant and equipment and less in buybacks. There are a few negatives about this corporate reform, which is generally positive. There is a limitation on interest deductions, which is initially to 30% of EBITDA, and then gets to a stricter rule of EBIT. So that takes out the depreciation and amortization. This is something that I've favored for years. The tax law has been quite biased toward debt and against equity, and this shifts the change a little, and it also raises quite a bit of revenue. A second thing that's not so favorable for companies is a limitation going forward on the use of NOLs, net operating losses. This is something a lot of companies carried back to the financial crisis and were able not to pay taxes for years. They'll still be able to do that with prior losses, but after 2017, NOLs will only be able to carry forward. They won't be able to be carried backward, so you won't be able to do what companies did after the financial crisis. A third thing is we're going to amortize research expenditures. This begins in 2021. It's either 5 years if it's in the US or 15 years if it's outside. But the good news is the R&D tax credit will be retained. So this will be a modest change, and it will come about only in a few years. Last changes, if you look at the rules that say that a company cannot deduct more than $1 million for its executive comp, there was an exception for stock options and other performance-based comp, which included RSUs and stock grants that were based on objective performance, like achievement of some earnings or revenue target. Those exemptions have gone away, so that the $1 million deduction limit will be pretty much firmer. I don't believe it's going to change much in the way of executive comp. Companies will just not deduct a certain amount above that. Pluses and minuses for certain industries of importance to the biotech industry. The orphan drug credit was reduced from 50% to 25%. The investment management industry will take a hit because the miscellaneous deduction was suspended. This is the thing that allows individuals who are paying investment management fees, if those are above 2% of their AGI, their adjusted gross income, they were able to deduct them in the past, but this is not true going forward. A third area is carried interest. This was a very controversial area. The performance fees of hedge funds and private equity funds are done in a partnership interest form. and there were many people thought that those ought to be taxed as ordinary income rather than capital gains. I think it's a tribute to the lobbying power of hedge funds and private equity that there was what I view as a token reform. If they hold on to these performance shares for 3 years, it'll be taxed as capital gains. So they basically avoided the bullet. The big winner here, which may not be surprising given our president's background, is real estate. They were exempt from the 30% limit on interest deductions, and the like-kind exchanges, which used to be permitted for all types of property, are now only permitted for real property. So that's the general picture. On the corporate side, a tremendous benefit, reducing rate, a few modest limitations. Certain industries do well, certain don't do as well. Now, I'd like to move to pass-throughs because this is probably the most complicated and least understood aspects of the new act. So let's start with a few definitions. A pass-through includes not just the partnership, it includes sole proprietorships. That's important because that means people who just are consultants and use Schedule C will be able to take advantage of this, subject to the limitations I'll talk about. It also applied to Subchapter S corporations and LLCs, which are taxed as partnerships or as flow-throughs. Qualified business income includes all income from these pass-throughs, plus REITs and other publicly traded partnerships, which are often in the energy area. So this is a big positive, again, for the real estate industry. It's also a positive for the MLPs in the energy space. But, and this is really important, is there are a list of what I call bad service firms, meaning these are firms that are generally, people who work there are not going to get this partnership deduction. We say generally it's where the principal asset is the reputation or the skill of the employees, and their specific bad services, healthcare, law, consulting, athletics, and basically all types of financial services. So the notion was that these areas should not have people becoming consultants, easily becoming partners, and transform themselves from companies into partnerships. In the very end of the tax bill, they excluded architecture and engineering, which are no longer bad services. Again, a tribute to the lobbying of these two industries, and some people would argue because they're related to real estate, which is clearly favored. Now, let's go through and understand this specifically. There is a new 20% deduction for all qualified business income that comes through pass-throughs. So if you're a partner in a real estate partnership and you would get a distribution and a taxable distribution every year, instead of being taxed at 37%, the new tax rate, your effective rate would be 29.6%. This was put into the law to give pass-throughs some sort of tax benefit because the lower rate for C Corps going from 35 to 21% doesn't really help them. Partnerships are very politically powerful, and this is what they got. But there are two important limits. One is, excuse me, and both of them relate to the income level of the person who is a partner and receiving this income. And the income levels are 157, 500, 157,000 for individuals, and 315,000 for couples. If you're above these levels, the first thing to realize, if you're in a service firm other than engineering and architecture, basically the 20% deduction is rapidly going to phase out, so you're not going to get it. Second of all, even if you're not in a quote unquote bad service firm, if you're above these levels, you'll get a limit based on 50% of the W-2 wages of the partnership, or 25% of W-2 wages plus 2.5% of tangible capital costs. That second was, again, a benefit put in for real estate. Let's sort of see how this works by looking at two simple examples. I'm only using individual taxpayers so that we won't make this too complicated. But suppose you're in an architectural firm. That's not a bad service. If an employee gets $250,000 as salary, there's no 20% deduction. They're not an owner. But if you're a partner of that firm and you get $250,000 in taxable distributions, you will get the 20% deduction, because you're not in a bad service industry, but you are subject to the W-2 wage limit since you are over the 157,000. So what does that mean? If you're just a sole architect with a secretary, you're probably not going to have very much W-2 income, so your deduction is going to be quite limited. If you're a partner in a big architectural firm where there are lots of people with W-2 wages, that's a different story. Another example I have is a university professor, one close to home, a salary of 100,000. Again, there's no deduction. Your employee. Annual consulting of 50,000. You get the 20% deduction because your total income, 100,050, is below the 157,000. But supposing you got annual consulting of 200,000, well, then you're over the 157,000. Consulting is a bad service, so you don't get the deduction for that. I'm going to stop there and let Lorry pose a few questions before we get into even more complex areas of international and individual.
Well, thank you, Bob. It's very interesting. We do have a number of questions that have come in. Let me ask first, what have we seen so far with respect to how corporations will use the money that's freed up from the reduced tax rate? You had mentioned that there was no limit on dividends, but do we contemplate substantial dividend payments or raises for employees, or money going back into plant and equipment?
Well, we've seen so far some companies reward employees by giving one-time bonuses. And so that's a way in which we're effectively raising wages. Other companies have said now, like Walmart, the starting level of wages will be higher. People could question whether or not that would have happened given the tight labor market, but that's clearly one use of it. Second of all, we see companies, Apple has made a big announcement. It's bringing back a lot of money from overseas, and we'll talk about that in a second. And it's clearly going to put money in a big center. That seems to be new. It's also going to put money in certain capital investments. Some people would argue that was already in the pipeline, but it's probably more than they would have done otherwise. Third of all, I think we will see an increase in buybacks, much more so than dividends. Once you raise your dividend, you can't lower it. It's without having a terrible impact on your stock price. So generally, stock buybacks are more flexible, and I think we'll see a lot of those.
So Bob, a common issue for somebody setting up a new business is whether to incorporate the business or to operate as an LLC, taxed as a partnership. In the case of a business that's not in the professional services business, how do you think the new Tax Act affects that decision between incorporating or operating as an LLC?
Well, it used to be a no-brainer. You would always start a new company as an LLC because the corporate tax rate was so high. Now it depends a lot on what situation you have in terms of your employee's tax rate. I guess I would say there still should be a presumption that you should use an LLC because you will not have the second level of tax. And you will also, if you have lower incomes, you will be able to take advantage of this 20% deduction. So those are two positives. But I guess the third thing I would say is it's actually quite easy to go from a partnership to a C Corp. It's quite difficult, especially from a tax point of view, to go from a C Corp to a partnership. So those are three reasons to say, in general, and I don't want to give tax advice, starting a new business, you're better off as a partnership. But there are some caveats now. There always was the caveat that sometimes the people who put up the money, especially pension funds, don't like to get operating income, which they can get from partnerships because that's taxed to them. And so they tend to prefer a C Corp. Second of all, if you're going to go public, again, there's a preference for a C Corp because publicly traded partnerships are more complicated. And third of all, we have a new one is it depends on the tax rate of your owners. And so if you have a lot of people who are above 315,000, well, they're not going to get any of these benefits, or very few of them, if they're in service industries or if there aren't a lot of W-2 people. So in that case, there could be an argument for a C Corp. So I still believe that for, the majority of startups, they're still better off as an LLC. But I think you have these three things that you got to look at pretty carefully now. One is whether you have pension funds financing you. Second of all, what your intention is in terms of going public. And third of all, the income levels of your employees slash partners. So it's a complicated thing, but the key is you can always go from a partnership to a C Corp. So that's a good reason if you're uncertain to start with a partnership.
So just one last question during this intermediate portion. There was considerable interest on the limitations on interest deductibility. And questions is it correct, the understanding that it does not apply to companies with revenues below $25 million? And what about its application to a small real estate firm that held, for example, 10 properties?
Well, that's a complicated question. There is, if you're a small firm, I believe there is an exemption under 25 million. So that does help you. Real estate firms, that computation is done at the entity level, even if they're a partnership. And if they're having enough, but for a real estate firm, they're not going to be subject to this 30% limitation, so they don't have to worry about it. If you have other types of partnerships that have a lot of debt, such as private equity firms that form LLCs to buy out companies, those will be subject to the 30% limitation. This thing about saying 30% of EBITDA is a very lenient rule, because that's earnings before you do interest, taxes, depreciation, amortization. So even if you have a lot of debt finance, if you have earnings before interest and before all these charges, you should be in pretty reasonable shape. Once you get to EBIT, then it becomes tougher, because these non-cash charges, depreciation and amortization, those will no longer be in your denominator. So again, you got to put pen to pencil, but I think that for most small businesses, surely real estate businesses, it will not be a problem. It will be something that private equity firms and leveraged hedge funds and other people will have to look at. Okay, Larry, let's go on and make sure we get enough time to cover international and individual in this, I would say, bird's eye view of the whole tax act. So let me see if I can do this. Okay, the international system was totally transformed by this tax act. We used to have a worldwide system where companies were taxed, C corps were taxed on all of their income across the world, but with this caveat, they were only paying the 35% US tax if they brought back the money to the US. So guess what? A lot of them didn't bring it back. There was at least 2.5 trillion in foreign profits held abroad. Under the new territorial system, most profits of US corporations will be taxed only in the country where the profits are earned. So this will be a big incentive for companies to move income to the extent they can, either to places like Bermuda, which already have a lot of intellectual property license out of there. They have no corporate taxes, they'll have even more. And to countries like Switzerland and Singapore, and there are a lot more that will offer the chance to have less than 10% on corporate income. This will have to be weighed against the lower corporate tax rate in the US. So the moving toward a territorial system is an incentive for people to move jobs and factories abroad, but the lower rate is an incentive for them to stay in the US. Now, the Trump administration recognized that in a territorial system, there was an incentive for companies to go to very low tax jurisdictions, and they established a very complicated minimum tax, which goes up to 13%. It's somewhere between 10 and 13%, depending on lots of stuff. But if, Lori, you and I were to design a minimum tax that looked like it was effective, but really wasn't effective, we would do this. So there are two big loopholes in this minimum tax. The first is that they only use the aggregate tax rate on foreign profits. So if you had, let's say simplistically, 100 million of income that was in Germany, France, and Japan, and was taxed at, say, an average rate of 28%, you could have another 100 million in zero rate tax havens, and your aggregate rate would be 14%, and you never pay this tax. So by being able to offset higher rate countries with lower rate countries, this can be managed very effectively. Moreover, and this is the point at the bottom of the slide, it's not your actual taxes on your actual foreign profits. It's what I call your actual foreign taxes on what might be viewed as your excess foreign profits. How do you compute that? Well, the tax bill, the tax act, now allows you to subtract from your foreign profits 10% of your tangible capital abroad. So looking at this example, suppose you had 9.5 million in foreign taxes on 100 million. So you would think you'd pay the minimum tax, but you won't if the firm had 300 million of tangible assets abroad, because it gets to subtract from that 100 million in foreign profits 10% of 300 million, which is 30 million. And so its foreign profits are reduced to only 70. These are two big loopholes. I don't really think they can be defended reasonably. And we need a minimum tax in a territorial system. And this one is really just a facade of a tax, minimum tax. It really doesn't work. I and other people criticized this before the act was passed. Clearly, senators and congressmen knew it, but this was something they decided to do. Last point about international, there's a mandatory repatriation tax on this 2.5 or 2.7 trillion abroad. and it came in much higher than I thought or other people thought it was going to be. It's 15.5% on profits held in cash, which most of them are. There's some assets which have already been bought, factories have already been built, that's at a lower rate. This is one of the main ways in which income was raised to offset, revenue were raised to offset all the losses that were going to come about in tax revenue. So this is a big one. And the difference between this and the tax holiday in 2004 is that was optional, it was voluntary. You only paid the repatriation tax if you actually moved the money to the US. Here you're paying it no matter what. So you've already paid the tax, you might as well put it in the place where it's gonna be the most profitable. So I think you'll see a lot of this 2.7 trillion or 2.5 trillion coming back to the US. Again, Apple announced that it was bringing back a big chunk, and you have a few technology companies, a few drug companies that have the bulk of this money, and I think you'll see a lot of it come back, maybe as much as 1 trillion. And last thing we want to cover is the individual changes. These are all positive. There's a bit of a myth that individuals did poorly, but I think across the board, rates are going down. Most people will see in their paychecks a 1 to 2% tax decrease. Maybe it's only $400 for somebody who's making 50 or 60,000, but for them, that's a big number. Obviously, as you go up, you'll have more. The gift tax and estate tax, the House wanted to abolish it completely. There was a compromise here. The exemption was doubled for a couple from 11 to 22 million. So that's the big gimme for the higher income people. That tax is really only paid by less than 1%. And so now they'll be able to exempt a lot more. Medical expenses were debated. In the House bill, that deduction was eliminated, but in the end, Susan Collins got the threshold lowered from 10,000 to 7,500 for 2 years, and then it goes back up to 10 years. So you get to deduct your medical expenses if it's above that amount. 529 plans, these are the plans that people use to save for college. They were extended to grammar and secondary schools, mainly as a benefit to religious groups that run these some of these schools, and therefore wanted that money applicable to tuition in these religious grammar and secondary schools. And as I said, becoming a contractor to get it should be 20% deduction, not 30% deduction. My error. If you're below the threshold, if you're an individual with income less than 157,000 or a couple with less than 315,000, this is really something you ought to do. If you're an employee, you ought to try to become a contractor, then you would get the 20% deduction. But you ought to realize that sometimes if you're not an employee and you're only a contractor, you don't get health care from your employer. So that's a big negative. And then your retirement plan. Yes, you can have a retirement plan as a contractor, but the corporate plans are often better. So before you move to become a contractor from an employee to get this deduction, check out the healthcare and the retirement side. Lastly, we want to look at these deductions that were cut back. The most notorious is now the $10,000 limit on what are called SALT deductions, state and local taxes. This includes property tax, and this includes state income tax. This obviously hits hard on a lot of the blue states, California, New York, New Jersey, Massachusetts, and people are thinking of creative ways to get around it. For example, maybe the Massachusetts will give a tax credit if you give a gift to the state government, and that would be something that would be deductible because charitable gifts are still deductible, but local taxes are quite limited. The miscellaneous deduction, as I said, was suspended for 10 years. The mortgage interest deduction, it's still there going forward, but the interest was limited to a $750,000 mortgage and no more interest on home equity loans. This is something I strongly support. The mortgage interest should be to help people get homes and become homeowners that don't have them already. I doubt seriously whether someone who has a $900,000 mortgage isn't going to buy that home now because the interest is limited to $750,000 of the mortgage. The interest deduction is limited to $750,000. No deduction for moving expenses. And the last thing I should say is we now have a doubling of the standard deduction for a couple. Goes from roughly $12,000 to $24,000. People don't realize that only 30% of taxpayers itemized before this change. The thinking is, the estimates are now that with this doubling from 12 to 24,000, maybe only 15% of the taxpayers will itemize. So some of these deductions limits, like the limits on local income and property tax and limits on mortgage interest deduction, this only really hits those people who are itemizers. So that group is going from 30% to 15%. So it really depends on your situation, but for a lot of people with small mortgages and at lower incomes, they're going to find that the $24,000 would be the standard deduction is more attractive than itemizing. So it's a very complicated thing to figure out who's going to really be affected. I'd say generally the people who get hit the worst are people who are making between $100,000 and $400,000 and live in blue states. Those people have enough income and their mortgages are big enough to want to itemize, and these restrictions will definitely bite for them. I want to end by being clear about all this debate about is it really important that the individual tax rates, these declines, will end in 2025. A lot of these caps and a lot of these things will also end in 2025. And people say, by contrast, the corporate tax rate reduction is permanent. Let me state very clearly, that's a lot of hogwash. 2025 is 2 presidential elections away. After the first one in 2020, there is very likely to be a renegotiation of many of these provisions, especially if the Democrats can take either the presidency or one of the houses of Congress. After 2024, this thing will not just end automatically. There's again going to be a total renegotiation. And so this at most says, well, certain people will have the benefit of inertia, that is, Congress not doing anything. So in those negotiations, they have a better hand to play. But I think it's very clear that this tax act is good for at most the next 6 or 7 years. And it may not even last that long, depending on what happens with politics. Remember that if Democrats capture the House and the Senate, it will only take, they can put through changes in this tax act, just like the Republicans did through budget reconciliation, which only requires 51% of senators and a majority of the House. So I would say, on the one hand, you should count on this for the next 7 years, and so you want to take advantage of the things that are important for you. But you ought to realize that this is not permanent. It's going to change. It's going to change politically. It's going to change in a lot of different ways. So let me stop there, Lorry, and take some more questions.
Well, Bob, this has been a tremendous presentation. Thank you so much. We have had practically 100 questions that have come in. So if your question is not addressed, it's not that we didn't like it, it's just that we didn't have time to get to all of them. But here's my favorite so far. You had mentioned, Bob, that you weren't in a position to give tax advice. Well, can you offer some investment advice? A viewer asked, what is the likely effect on the U.S. equities market of the tax legislation? Do you think it's already been built into the pricing of stocks, or is this likely to be a continuing boom in the pricing of equities?
Well, like most things, big things that happen, part of it was built in already to the stock price. But the reason why I think you've seen the market take off in January is there's a big difference between a probable tax act and an actual tax act. And now we have an actual tax act, and we will see in particular companies some real money coming back from overseas, and we'll see lower tax rates. We also see a number of companies that have booked big non-cash losses. Now, why is that? It's because they have had these net operating losses, which they've been carrying forward. So a company, many say like Bank of America, booked a big loss because it had this deferred tax loss that it was planning to use in the future. And now that the rate went down from 35 to 21%, that deferred tax loss is worth less. But I can assure you the people in the Bank of America are very happy about the trade-off. Yes, they're booking what I call a non-cash loss. That doesn't affect the real cash and the real money. And going forward, they're going to pay a much lower rate, and they're going to be much more flexible in terms of that. So I think part of this was built in, but part of it we're seeing now. I think it differs a lot from company to company. And I think it's obvious that stock market's at all-time high, and therefore no one knows, I can assure you, no one knows when the correction is coming, but it is coming. We just don't know when.
What is your view of the attempts by various states to essentially circumvent the limitation on state and local tax deductions, either by thinking about imposing a state payroll tax or having a charitable organization that might support the state, that if individuals made charitable contributions, they would receive a reduction in their state tax obligations?
I think the proposals to impose state payroll taxes are not going to be very workable. That's because people are in very different situations, whether they're employees or partners or whether they're contractors. And this would be a mandatory payroll tax, and it's going to have very uneven effects. And there are going to be lots of people who are going to object to that. Charitable contributions have a lot more, I think, possibilities. It all depends on design. Let's take in Massachusetts, if the state doesn't allow at the moment any charitable deduction. So if you said you're allowed to contribute up to X, 100,000, 200,000, whatever the number is, and take a charitable deduction for that, I think that might work. Yes, people would say it's designed to circumvent the federal tax law, but the tax law is pretty complicated. So having a technical way to avoid a tax or to minimize it or to get a better deduction, I mean, that's what the tax law and tax lawyers are all about. I think it's much more complicated if you say, well, if you make a charitable contribution to the city that you're living in, let's assume it's Wellesley or Winchester, and then you'll get a deduction on your state income tax, because then the money is going initially to Wellesley or Winchester, and then the state loses money on the deduction. So then there has to be a transfer of money from the cities to the state. I can assure you the cities are used to getting money from the state. They're not used to transferring it. So that may turn out to be quite complicated. I think we'll see it. We'll definitely see it at the state level through charitable deductions. And I think the courts will have to figure out whether it's workable.
Could you say a few words about the taxation of U.S. citizens worldwide? Do they continue to be taxed on their worldwide income?
There's pretty much, there isn't much of a change for the taxation of individual citizens. The international tax was restructured for companies, but individuals are still roughly in the same position.
What about oil and gas exploration? Were there any new or incentives provided for?
Well, oil and gas did pretty well. The basic depletion allowance stayed. There were a few more recent incentives that were cut back, but I think they did just fine. And there were proposals to cut out a lot of significant things in oil and gas depletion. There were proposals to cut out a lot of credits for renewable energy. Most of those didn't go anywhere. So I think oil and gas did well because its main depletion allowance stayed. MLPs were treated well, and a lot of energy is done through there. And third of all, most of them are organized as partnerships. They're not a bad service, so they should be able to get the 20% deduction.
So we had many questions about the 20% deduction for professional service firm,
Right.
which, among other things, indicates that the U.S. Treasury Department is going to have its handful writing regulations in this area if they get back to work in the near future. But I might pick off just a handful of those. One is an LLC that is taxed as a corporation. Does that allow for a 20%?
Almost every LLC is taxed as a pass-through and not as a corporation. That's the point of having an LLC rather than a C Corp. An LLC is a corporation for corporate purposes, but is a pass-through for tax purposes. Therefore, the shareholders of an LLC are considered partners for the purposes of tax law, and they will be eligible for the 20% deduction on their distributions that are made to them, subject to whether they're under the income limits and the bad service limit and the W-2 limit. So owners of LLCs will definitely be eligible for the 20% deduction.
A number of individuals asked if you might simply confirm your observation about sole proprietorships that are not set up as partnerships or pass-through entities at all. Are they entitled to the 20%?
Yeah, generally they are, but I think that there are two things. One is a lot of the sole proprietorships are in consulting or these sorts of things. So they're over the income limits. They're definitely gonna not get anything. The second is if you're really a sole proprietorship and let's assume you run a small store, well, and you're not, and you're over the income limits, well, then the question is how many W-2 employees do you have and how much W-2 income does the store have? If you're a sole proprietorship and you have 2 employees, then you may not have very much W-2 income and your deduction is limited to 50% of the W-2 income. So I think you got to look at this. The first question is whether you're under those income limits. If you are, then you know it's generally worth taking, and as a sole proprietor, you'll have it. But if you're over those income limits, the first question is, are you in a bad service industry? If you are, forget it. Second is, even if you're not in a bad service, do you have enough W-2 employees other than you in your enterprise to create enough W-2 income to make that deduction worthwhile? That was put in the tax law to encourage people to hire employees, but it really works against sole proprietors.
So we had one individual who asked about somebody that had a cake decorating business that generated, say, $10,000 of income, set up as a sole proprietorship, no W-2 payments at all. And his wife earned over $315,000. Is he out of luck on any pass-through?
Yeah, you would definitely. It's assuming you and your wife are filing jointly. They will look at your total income and not your individual income. Of course, people say, well, they'll get divorced to do this. I'm not sure I would recommend that, and then people can file separately. But basically, if you're a couple, and the IRS is going to look at you that way.
So Jerry asked a different topic about capital gains rates. And why is it that we believe in graduated rates for ordinary income, but a flat rate for capital gains? What are your thoughts about that?
Well, we don't quite have a flat rate for capital gains, because for people with investment income over, it's in the 250,000 range, we now have a surcharge of roughly 3.8% for healthcare. So the top rate can either be 23.8%, can be 20%, and it actually can be 15%. So there is, I would say, a very modest graduation. It's not like the income level of income graduation, the graduation and the income tax. But there is a modest graduation. But when you start with a tax that's basically 20%, well, there's not a lot of room to maneuver. So you got 23.8%, 20%, maybe 15%. So you have that. I guess it all comes down to this: is Congress has traditionally favored capital gains because they believe it's important to encourage investments in companies to grow the economy. And that's why we basically give people a much lower rate. Once you decide you want to give them a much lower rate, then you can have small differentiation. But you've pretty much made the decision to let the higher income people have a lower rate for public policy reasons. Whether those public policy reasons are right or not is much debated. But I'll say this: movements in the capital gain rates are much more have much more effect on revenue than movements in the ordinary income rate. People have the choice whether to realize capital gains. So if you move the capital gains rate from, say, 20% to 35%, it's not clear that you would raise more revenue at all, because a lot of people would either slow down or not realize their capital gains. So by contrast, if you change the ordinary income rate as we're doing now, say from 39.6% to 37 and from 25 to 20, most people will keep working, and they may at the margins work a little more or less, but that's very different than the decision whether to sell stock or sell a business, which is much more discretionary.
Well, since we will all need a long vacation after thinking about this tax legislation, Carol asks whether the mortgage interest deduction is still available for second homes.
It is available for second homes, but only to the total of $750,000. So that's something that some of us thought that the deduction should be limited to your main home. Again, if you're using it to buy a second home, by definition, we're not encouraging home ownership because people already own the first home. So the public policy issue is muddled, but I think people who own second homes and in places like Cape Cod were obviously terrified that this wouldn't apply to them. So it does apply. But you take the mortgage on both homes and put it together. You can't deal with them separately.
So maybe one more question, and then you could perhaps offer a wrap up. But could you comment on the prognosis for the personal alternative minimum tax? Over the years, the failure of Congress to adjust the AMT for inflation has been very deleterious to this particular individual. What's the future of that tax?
In the House bill, the House bill eliminated the AMT for individuals. And I think the Senate would have liked to do it. But what happened was basically the 1.5 trillion was established as the total permissible deficit for this act within the first 10 years. Then it had to be revenue neutral. So there was a trade-off. And I think probably a fair statement is the partnership groups came in very strongly. Think about this. The main beneficiaries of this act are companies. They get the big cut from 35 to 21%. Yes, they have to pay repatriation tax. Yes, their limit on interest, but they're the big winners. And that's where $1 trillion of the 1.5 trillion in deficit is created. Then you went to individuals, you gave them, most individuals got modest individual cuts, and we had some limitations like the ones on miscellaneous deduction, on mortgage interest, and of course, the politically motivated SALT restrictions, which had, I think, a very strong political base. Then the partnership groups come in and say, well, we want our goodies too. The big corporations, the international corporations, they've all had what they want. So we want more. And that was the real sticking point in the whole debate. So in the end, the partnerships had to get more. As we've discussed, it's an incredibly complex provision, but somebody had to pay for that. And in the end, the individual AMT was modified. So it applies to fewer people, but it's still there. And ironically, if you're in AMT, then you shouldn't care about the restriction on deductions for property tax and local income tax, because when you compute the AMT, you're not allowed to deduct local property tax or income tax. So you were really never getting the benefit of that. That's why I say this restriction and all these things hit mainly people between 100 and 400,000, because once you get over 500,000, a lot of those people are in AMT anyway. So some of these restrictions really don't apply. The charitable deduction is still there. It's still you allowed to deduct it for AMT purposes, but the doubling of the standard deduction may have some effect. I would hope that over time we would eliminate the individual AMT. It's so complicated and it makes everything really very difficult. But the basic idea of the individual AMT is that no one should pay less than 28% or 27% of income tax. And that's, the AMT moves toward that. It's so complicated, it obviously doesn't do that for everybody. So it's still there. It applies to fewer people. If I had a guess, it will be there for the rest of our lives. It will be modified. It will be indexed. It will be various other things. But there's probably enough support for the notion that there's got to be some minimum individual tax. We don't want to see very high income people paying zero or close to zero. So that's our vehicle for doing it. And let me just use that as a segue to the end, Lori, and thank you for doing a very good job as moderators. But everything I've said here is a general overview. When you get to any of these issues, you really got to put pen to paper and really run a few examples to see how they work. This is an incredibly complex act. If the goal of this tax bill was to simplify taxes, we'd mark them at MIT, we'd give them a D on that because they made it much more complex. People will spend lots of time on these partnership provisions, these international provisions, and as people pointed out, the individual AMT was there. Let's face it, this was a tax cut. That's what it was. 1.5 trillion to tax cut. 2/3 of that tax cut went to companies because the US had a very high rate. So the critical question for the economy is what those people in the companies are going to do with that money. Are they going to promote economic growth as Republicans hope, or whether they're just going to give it back to shareholders and other owners? That's the critical question. 500 million of that went to individuals. It went to individuals in very complicated ways, but in general, people will see a larger paycheck, and that's a positive thing. So we'll see what happens. And as I said at the end, there's definitely going to be a total renegotiation in 2024 and 2025, and we may have one sooner, depending on the politics. So get out your pencil and paper. All you MIT alumni are good with numbers. So go through a few examples and try to see for yourself what's the real effect of this act and what you should do as a strategy. Thanks very much, Lorry, for emceeing, and I'm glad we had so many questions. They were good questions, and we'll just have to have people on their own a little to sort of work out how it applies to them.
Well, Bob, we can all join in with Raymond, who wrote in to say, thank you, for Professor Pozen. This overview was very helpful. Good job.
Great.
Thanks for joining us. And for more information on how to connect with the MIT Alumni Association, please visit our website.